Dear clients, I'm Richard, Phillip CFD dealer. Financial markets tiptoed into March on jittery feet amid the ebb and flow of the Ukraine saga. But as the month progressed, it seems that while tension remains, the global repercussion of this geopolitical event appears contained. For instance, last week, the worst-case scenarios subsided to the back burner as the Crimean referendum on secession went ahead without any major violence, and Russian President Vladimir Putin assured he has no intention to partition Ukraine. A sense of relief greeted market participants, and their attention was refocused towards global growth outlook, where encouraging signs of spring pause were exhibited by the US economy. Back in the US, data ranging from building permits to leading indicator index to weekly jobless claims all suggested that economic activities are either stabilizing or improving post-weather distortions. During the second half of March, we have had the much-awaited first FOMC rate decision chaired by Ms. Yellen on March 19th. Against a hawkish undertone spurred by the US economy regaining its momentum, markets interpreted from the meeting that the Fed's stimulus program could end somewhere in October this year, and policy rate may rise about 6 months thereafter, which is earlier than markets have previously anticipated. Notwithstanding a brief pullback that ensued following Ms. Yellen's hawkish remark, overall upbeat market sentiment nudged the S&P 500 index 1.4% higher last week, and the benchmark recorded yet another new intraday high on last Friday. Conversely, VIX, commonly known as the Fear Index, fell the most since Feb, sinking 16% to 15th for the week. In cross-market actions, we also witnessed broad-based dollar strength on the FX front, as market participants bolstered expectations for the US economy to be a key driver of global growth, and for the Fed to make a rate move sooner rather than later. Not to mention that the above confluence of events also showed safe haven assets into out-of-favor territory. Gold, which rallied 15% this year on earlier signs of a faltering global economy and geopolitical tensions, fell to the lowest level since mid-February. US Treasuries yields, particularly those of short-term maturities, jumped upon Yellen's comments, resulting in a flattering of the Treasury yield curve. Well, perhaps the prospects of rising rates in the US may not be the most welcomed by some developing markets, as it threatens to draw capitals away, hence pressurizing developing equities and currencies. Nevertheless, in Asia, regional markets rebounded since mid last week, as this concern was largely offset by the regional market's hope for stimulus from the Chinese government to support economic growth after 3 straight months of China PMI contractions. On a concluding note, it is interesting to highlight that for the past 5 years of this cyclical bull run, the S&P index had finished March on a higher level than it started with. Hence, barring major negative market surprises, the global equity benchmark, riding on the back of renewed US economic momentum and receding geopolitical headwinds, could stretch its unbeaten feet into the 6th year. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Phillip ETFs. That's all we have for you today. I want to win a pair of tickets to our Poems 2Q14 Outlook seminar worth $50. Look out for our next Monday's weekly Market Watch topic on PhillipCapital's Facebook page, and pose the questions that you would like our analysts or dealers to answer. The top 3 questions will win a pair of tickets to the Poems 2Q14 Outlook seminar, which will be held on 5th of April. Please submit your questions by 10 a.m. on Monday, 31st of March 2014. Thank you for watching today's Market Watch, and tune in on 31st of March evening to see whether your answers will pick.